Hello and welcome to NavTalk. NavTalk is proudly brought to you by the Navwealth Financial Group, helping you reach your destination in life on purpose. My name is Simon Prowse and I'll be your regular host for this series of podcasts. And I look forward to bringing you interviews and content on a broad range of topics. Topics that will be educational, inspirational, informative and at times fun. Hello there everyone and welcome to today's NavTalk entitled Simply Super. My guest today is Alistair Mettam. Alistair is a senior financial advisor here at Navwealth and has been working with super funds, both self-managed and retail, for many, many years. Welcome, Al. Yeah, it's great to have you along, mate. Before we get into today's topic, tell us a little bit about your journey to becoming a financial planner and a super specialist.
Yeah, so Simon, I guess I went to university and did a commerce-based degree and always had an interest in banking and finance, and then finished uni and sort of found myself in a large financial services business, and it's really just kind of grown from there and sort of moved through the ranks and sort of moved up as an advisor.
So you found your specialty as you were working in the bank?
Yeah.
Okay.
Yeah.
And that's led you to become a financial advisor. What does that mean? Is it?
Yeah, so did my university degree, but that these days doesn't mean you can be a financial advisor. It's really just kind of your ticket into the industry. And then I've gone on and specialised and done other sort of financial planning based qualifications.
And what's that qualification? Have you got a certificate in financial planning?
Yeah, so I've done a diploma in financial services, financial planning, done an advanced diploma in financial planning, and then I've gone on to do my certified financial planning kind of certificate, which is sort of I guess a bit like in an accountant would be a CPA or a CA for an accountant.
Oh, great. And in that course, you've obviously had a lot to do with super and a lot of exposure. Yeah,
super is a pretty core element of financial planning. So those courses cover a lot of sort of superannuation-based strategies.
So, Al, the topic today is simply super, but it's really not simple, is it?
No, Simon, not simple at all. I mean, I guess so many different rules, regulations, and these rules and regulations change pretty regularly with either changes of government or just changes in, from year to year with changes with the budget and so on. So, yeah, it's certainly not simple, and we would certainly suggest people always seek advice and so they can sort of tailor these rules and regulations to their individual circumstances.
Yeah, look, I think in every budget there's something about super, isn't there?
Yeah, absolutely.
So what is super? Tell us what
Yeah, so I guess super, it's essentially putting funds away for people's retirement. People probably don't realise, but super actually in this country only came in 1992, and basically the super guarantee when it came in was 3%. It was a Labor government, Paul Keating at the time, and basically that was essentially employers putting 3% of people's salary and wages away as a measure to, basically build some sort of savings for their retirement.
I think Paul Keating at the time was worried about that baby boomer wave and actually the government being able to fund pensions.
Yeah, essentially, because obviously in Australia we've got an ageing population, so certainly probably at the time they had a bit of foresight to think that, people needed to build their own retirement savings as opposed to relying on the government and paying them a pension.
Well, it makes a lot of sense if you're in the government. And super's now just about to tick over and hit about 10.5. That's gone a long way from that 3%.
Yeah, so over the years from 3, it's sort of grown to 9 and then went to 9.25 and then 9.5, and then it's sort of gone up in 0.5% increments. And for the new financial year from 1 July 2022, it'll be 10.5%. And then by 1 July 2025, it's legislated to reach 12%.
And that's an awful lot out of one's salary.
Yeah.
For an employer.
Yeah, and especially for the younger generation who have had super their whole working life. A lot of baby boomers and older people in the workforce didn't actually have super for their majority of their working life. So for the younger generation to have, probably at least 9% and growing to 12, and then who knows where it gets to in another 20 years, that's a significant contribution towards their retirement savings.
And I dare say there's going to be some significant balances when these people get to retirement.
Absolutely, absolutely.
So, Al, you've covered the super contributions or the rate. What are the types of super that are out there?
Yeah, so Simon, typically there's three sort of broad structures that people can have their superannuation in. First one being a master trust, which is essentially a pooled trust where people's superannuation is all pooled together, and these sort of structures are typically offered by retail and industry funds. Everyone will be pretty familiar with the industry super funds on television, and they're typically what's known as a master trust. So, however many hundreds of millions, billions get invested in that particular superannuation fund, everyone's money gets pooled together, everyone gets the same unit price, same tax treatment, and then basically then the distributions are sort of divided back up to the individual members, and that's essentially all the member or the client is doing. They're just a member of the fund, and then there is a trustee that kind of governs that superannuation fund.
Okay, and then you mentioned there's three. What are those other two?
Yeah, so then the other type of structure is a wrap structure, and these are typically offered by retail providers. And a little bit different to a master trust. Wrap structures are individually taxed as opposed to a master trust where it's a pooled tax structure. So with a wrap, how one's individual super is invested is going to determine the outcome of that individual client's account. And I guess typically with a wrap account, they offer you far more flexibility in terms of investment options, doing things like shares or ETFs or managed funds, and far broader range of investment options available compared to your traditional master trust structure. And then the third structure, which many people would have probably heard of, is a self-managed super fund. And I guess for people would typically do a self-managed super fund when they want greater control over their super, or typically want to do a strategy or an investment that they couldn't otherwise do in the previously two mentioned structures. And a classic example is maybe they want to invest in direct property, whether that be residential or commercial, or some sort of unlisted investment that isn't able to be done in a master trust or a retail wrap structure.
Okay, we'll talk investments within super in a little bit. So essentially what you're saying is retail, you just put it, you have very little control, right through to self-managed where you've got extreme control. So it's really a balance of what that person's looking for in terms of how much they want to really get put on their super.
Absolutely, yeah. So I suppose which structure is appropriate for what client is really going to be determined about what their needs are, typically what their superannuation balance is. Typically, probably a self-managed super fund probably doesn't warrant itself unless people's balances are sort of getting towards that higher amount, just because of the sort of the cost versus benefits just doesn't make it feasible for much smaller superannuation balances.
And if a client's with a financial planner, will you probably find that the wrap style super is more of the norm when it comes to that type of client?
Sometimes. I think it's really on a case-by-case basis. Probably 10, 15 years ago, I think the flavour was self-managed super funds, but typically what's happened over time is these wrap accounts offered by retail providers of sort of the cost has come down, more greater options in terms of investments and greater flexibility. And so they've really sort of become quite a popular structure in the market these days, where people traditionally probably went and set up a self-managed super fund because they wanted to do direct shares and that was really the only option. But now people don't necessarily have to do a self-managed super fund and can go with a retail wrap provider to still do shares and those types of investments.
So a retail wrap provider, you could actually have control over all those investments.
Yeah.
You go direct share.
Yeah, you could work with an advisor and build a sort of a customised portfolio inside the super account. if you didn't want to go sort of a standard default option, which is probably more traditional in an industry fund. You know, you just go and pick the balanced or the growth option, set and forget, and off you go. If a client wants to get a little bit more hands-on, but not to the extent of a self-managed super fund, that still can be done through a wrap structure.
Well, that's great. Now, we've covered the different types of super funds. Now, how do we what are the phases and how do we deal with super as it's throughout our life?
Yeah, so typically there's a few phases of superannuation, and I guess most people in their working life, as they're building super, this is what's known as accumulation phase. And typically what happens is as money goes into super from your employer, or if an individual elects to do some salary sacrificing, for example, on the way in it gets taxed. Still quite concessionally taxed compared to a marginal rate of tax. And then typically in the accumulation phase, when the funds are in there, the income or sort of the investment earnings are taxed at 15%.
So all money's taxed at 15 in a general sense.
Yep.
Whether it's coming from an employer and or what its what its growth is in the year. It's income it's earned from dividends.
Yeah, it's important to note that the capital value, for example, if you had $200,000 in super, that's not being taxed at 15% as a capital tax. It's really what income is derived off the 200,000 that gets taxed at 15%.
Right. So like any asset outside of super, for example, a property, are taxed on the rental income, not the property itself.
Correct.
Okay. And I say that, not the property itself, but super has the same sort of tax on capital gains, but it's concessional again, yeah?
Correct, yeah. So a bit like capital gains for investments outside super. For investments held inside super, basically the tax gets cut by 1/3 and basically, can be lowered to 10%.
10% tax on a capital gain?
Yeah.
That's amazing.
Yeah.
Wow. Okay. Now, the other phases, we've had the accumulation phase where as we're young and we're getting to a certain age, then what happens?
Yeah, then there's what's known as a transition to retirement or TRIS phase. This phase is probably not so popular with some rule changes that happened back on the 1st of July 2017. And so this is now taxed in the same way as an accumulation phase super fund. So not as popular these days, but certainly does have its merit for certain circumstances. And then the final sort of phase is pension phase, and that has zero tax.
So zero tax, what's that? On contributions, earnings, what?
So zero tax is on the capital and on the income. And when you're in pension phase, you are required to access your super and pay yourself an income. And over the age of 60, there's no tax on the income payable to yourself.
Okay. So let's say I'm in pension phase. Can I still get money into super?
You can, but it can't go directly into the pension fund itself. It still has to go into an accumulation super account. And then maybe from certain time to time, you would do what's known as a pension refresh, and where you can add that money that you've added to super in the accumulation phase into the pension phase.
So the accumulation is still taxed at that 15%, and then we roll it in or move it into the pension at a point in time, and it goes to 0%, but based on earnings from then on.
Correct.
Yeah, right. What's the difference, if you like, this transition you mentioned and pension? Transition is we're moving to pension.
Yeah, it was typically came about when essentially, as the words say, people were sort of transitioning to retirement. And as I mentioned, prior to 1 July 2017, people could set up a transition to retirement pension account. Hadn't met a full condition of release, but it was still taxed in the same way as a pension account, being zero tax. However, the government, when they restructured super in 2017, these probably didn't become as popular because they're taxed in the same way as an accumulation account. But typically people, set one up. Maybe they were transitioning, they reduced work hours, reduced income at work, but then they wanted to still pay themselves a little bit of superannuation to sort of offset the reduced income that they were earning. And that was a really nice way for people to sort of transition to retirement, I guess.
Okay, so really they're just accessing super before they retire and get into pension phase.
Correct.
Okay, so you mentioned something along the way there. You said this word or a couple of words, which is condition of release. Talk to us about what that means.
Yeah, so the government typically want you to build your super and build as much super as you can for your retirement. But when it comes to actually accessing your super, there are certain rules and conditions. You can't just, get to age 45 and suddenly go, well, I want, $500,000 in super that I've accumulated to do something with, because it's preserved and designed for your retirement. So when you get to the point of wanting to set up a pension account, essentially you need to meet what's known as your preservation age, and this is really the earliest point that someone can access their super. And then there's additional condition of releases that people need to meet. So these are basically, they need to have met their preservation age and retire, or they've met their preservation age and they begin a transition to retirement income stream, or they cease an employment arrangement on or after the age of 60. You reach age 65, regardless if you've retired or not, or you pass away. They're essentially the most common condition of releases. And if you've met some of those, then you would be able to access your superannuation.
Okay. So if I've hit 45 and I think I've done really well and I'm ready to stop work and retire, I can't get my money.
Not normally. There are special circumstances that someone may be able to access their super in special circumstances, and these might be permanent incapacity or severe financial hardship or on compassionate grounds, for example. But generally speaking, no, unless you meet one of those sort of special circumstances, you can't access your super. It needs to stay in accumulation phase.
So you're really waiting till you reach that preservation age before it becomes a real bella.
Yeah.
And you mentioned 65. So you could still be working in full capacity and doing everything you normally did, but at 65, you can just get your super.
Yeah, 65 is kind of, I guess, the gate. All the gates open. It's sort of the the last hurdle, I guess.
Okay. And we might talk about accessing super and how we do that in a different way in a bit. But once we've hit 65, we can take it. Or if we're under 65 and we can transition to retirement, but that's again based on an age, I assume.
Yep.
Or we can show a special reason.
Yeah. So the classic example is someone's ceased work after reaching the age of 60. They've also met their preservation age. Then that's kind of a window opening to be able to set up a fully accessible pension.
So let's say I've hit 65. I'm still working and I can access, the gates are open, as you said, and I can access my super. Do I take the lot? Can I take everything?
You could, but typically most people probably wouldn't do this because I guess taking a large amount of money out of the superannuation environment, then there's going to be problems getting that same amount of money back into the system because there's, caps and rules about how people can get money into super. So typically what most people would do would be pay themselves a pension, whether that be a monthly or quarterly pension where they can drip feed an income stream to themselves in their retirement.
Okay, so I think I've got this right now because we've hit preservation age and the super's gone to pension, there's no tax on all its income and growth. So I'd be crazy to pull it out because it's in a tax environment when I pull it out.
Correct. Yeah. I mean, typically, if the client or the person has significant assets in their own name, other investments, are still working, still earning income, paying marginal rates of tax, and you've managed to accumulate money in a tax-free pension fund, then it wouldn't really be feasible to start pulling lump sum money out of a tax-free environment to then put it into a taxed environment.
I think it'd be stupid, right? All right. So we understand now how we get it out, and we understand how and when we can get it out. How do we get it in?
Yeah, so typically these come under contribution types or contribution rules, and there are a few different ways that people can get money into the superannuation system. The first one is concessional contributions, and the current cap is $27,500 per financial year per person. And this is generally made up of what an employer would pay an employee attributable to, i.e. the 10.5% on their wages and salary. An individual could also elect to salary sacrifice, where they forego some of their wage in their back pocket and elect to put that into super pre-tax. Or you could also do a personal deductible contribution, where basically you use after-tax money, put that money into super, and then claim a tax deduction on it. So it is treated as a concessional contribution. And those three types, being employer SG, salary sacrifice, or personal deductible, they all count towards the $27,500.
Okay. So the $27,500 is everything where we can claim a tax deduction effectively.
Correct. So I guess an example might be an individual might have $15,000 going into their superannuation fund that's attributable to employer super guarantee. Then they could elect to then put in the difference up to the $27,500 cap, either as a personal deductible or as salary sacrifice.
Okay, that makes sense. And then you mentioned this other way you can get it in?
Yeah, the other way is what's known as a non-concessional contribution, and the current cap for that is $110,000 per financial year. And that's basically using after-tax money. So when that money goes into super, it is not taxed. And a classic example might be someone might have sold an asset, might have got an inheritance. They've already paid their various taxes and duties to get that money into their bank account, net proceeds, let's call it. If they then elect to put that into super as a non-concessional, then that money would go into super with no tax.
Oh, okay. So it's not tax deductible when it goes in, but it's not taxable when it's in there.
Yeah.
Okay, that makes a lot of sense. Do you see a lot of this non-concessional type contribution?
Yeah, definitely. I think typically for probably older people who, maybe have paid their mortgage off or they've got inheritance and they want to really start to build their super in their sort of latter working years, then this is typically a strategy where people really start to build their super quite quickly and use the non-concessional cap, rule to be able to get large lump sums of money into the superannuation system.
So it's getting closer to that retirement age when people tend to focus on
typically, because I guess as we noted before, while you're working, while you're in accumulation and you're under your preservation age, then super's locked away. So typically for younger people, putting large lump sums of money into super when they still might have a mortgage or other financial needs, it probably doesn't make too much sense for them, because once it's in the super system, they won't be able to access it.
Yeah, so tell me a little about the limits. You mentioned 27.5 on concessional. What's the limits on the non-concessional?
Yeah, so the non-concessional cap is 110 per financial year. However, there is what's known as a bring forward rule, which is where you can bring forward years 2 and 3 into year 1 and do up to 330, so 3 years worth of 110. And you can do that in one go. And then basically then for the next 2 financial years for non-concessional, you can do 0, and then basically then the non-concessional window then opens up again.
Okay, so every 3 years we could jump 330.
Yeah.
But in the interim years we're not allowed to dump.
Yeah, however, doing non-concessional contributions of any type, whether it be the 110 or the 330, people do need to be aware that it is dependent on their total superannuation balance, which currently sits at $1.7 million. And so if you're getting close to various thresholds, then people might be limited on how much non-concessional contributions they can do.
Okay, so if we're at 1.7, we couldn't do a non-concessional, we're just barred from it.
Correct.
Okay. You mentioned concessional. I believe there's a bit of a loophole now, or a bit of a window that the government opened on these concessional contributions and how we might get some more money in that environment.
Yeah, so Simon, this is what's known as catch-up concessional contributions, and basically the government opened up the rules and basically said that people that had unused concessional caps could go back to prior financial years and, essentially add those funds that they hadn't, put into super and catch those up and then put them all in as a lump sum into super. So basically, at the moment, you can go back to the 2018-19 financial year and you could accrue unused amounts and put those into superannuation.
Okay, so if I, in 2019, put 15,000 into super, I could catch up the difference to 25?
Correct.
In that, because it was 25 the cap in that year.
Correct.
So I could pick up an extra 10 grand and claim it as a tax deduction this year.
Correct.
Wow.
Yep.
Okay. So
and then you could do the same if, for example, if you'd only done 15,000 in the 20 financial year, the cap was also 25,000 in that year. You could also go and put an additional 10,000 there. So basically, people are allowed to catch up those years, and whatever that accumulated amount is, you could put that all in one go as a lump sum and claim that as a tax deduction. It is worth noting, though, that people's superannuation balance does need to be less than 500,000 at the prior 30 June to be able to utilise this piece of legislation.
Can you just explain that, the prior 30 June?
Yeah.
So let's say we're now 30th of June.
Yep.
Well, let's go back a week. We're at the 25th of June. It looks at the balance.
As at 30 June 2021.
Okay. And if it was under 500, I can do the catch-up.
Correct.
If I'm over 500, it's gone.
You can't do the catch-up.
Do you think this catch-up, the point in time, 2019, will stay there forever moving forward, or is it going to be a moving window? Like they're going to let you go back 5 years or...
You can only catch up these amounts for 5 years. So if it's sort of a use it or lose it type system.
Okay. That's important to note. But more importantly, we had a good year. We've got a bit of money floating around, and maybe we've got a great capital gain that we've generated. We could go back and catch up those prior years and claim it as a tax deduction in our personal name.
Correct.
Wow. Okay, so we've talked about concessional and non-concessional contributions, and there's a few other ways you can get money in. Without getting into too much detail, what do they look like?
Yeah, so Simon, there's other ways people can get money into the super system. One is a downsizer contribution, and that's typically where people have sold their house and basically they are able to put some proceeds of the sale of the property into super.
Okay.
However, there are certain rules and restrictions and age limits on this. The other way is what's known as small business CGT rollover relief, and there's a few different sort of rules under that contribution type where people, selling a business can put proceeds of the business sale into superannuation as well.
Okay. So that probably looks after those people that were employees and typically haven't got their big super balances moving like an employee might, 10%.
Yeah, typically, you might find the older generation have been self-employed their whole life, maybe only had sort of super for a quarter of their working life, haven't really accumulated too much super. They've been more interested in running their business and paying themselves, and rightly so. But there are ways when they do come to sort of retirement and sell their business, there are ways and opportunities to get some of the proceeds into super as well.
So, look, we've covered quite a range, and thank you, because it is a very, as you're sort of rightly showing us, it is quite complex, this super, and there's nothing simple about it. What talk to us about what a super can typically invest. What's a super assets portfolio? Like, it's a lot of money. You're not going to leave it in cash. What's it investing in?
Yeah, so I guess, there's many different types of investment options and solutions available for people to invest inside super. And I think probably it might be one thing that a lot of people don't realise. They think, super, it's restricted, it's locked away, and therefore there's, the investment options must be quite limited. But that's certainly not the case. Things like direct shares, managed funds, exchange traded funds, listed and unlisted investments, property, whether that be, residential or commercial. So there's many different ways to invest in super. And I guess what the best mix of those investments really depends on the individual circumstances and their appetite for, risk and reward. So I guess it's really probably best to speak to a financial advisor when working out how you should, build your investment mix inside your super.
So literally, am I right in saying that the assets or the investments can be as broad as your mind, like anything outside of super is possible inside? How would that be restricted? Like, let's turn it on its head. What couldn't we do in super?
Yeah, so I guess with all these things, it's not just a free-for-all, and it's not just open slather and you can't just go and invest in anything. And typically, we spoke earlier about different superannuation structures. Some are more restrictive than others, like a master trust, industry or retail fund. Typically, they don't have as much flexibility as a self-managed super fund. So I guess if people were wanting to really sort of explore the boundaries and opportunities of what other types of investment options they could do, it would be best to speak with an advisor and then typically tailor a super structure that suits that investment mix.
Yeah, look, knowing a bit about this, it's probably one that if you are going to go something a bit left field, you should definitely seek advice, because you do not want to fall foul of the super rules. Yeah,
absolutely.
Okay. Looking at the super and the industry itself and where we're going, what's your key takeout for people, especially the younger ones out there? I've had many a conversation with a client, 30 years old, begrudging the fact that they've got money going to super, they can't touch it, they can't do anything with it. Like, give us a little bit on what that means, because it's pretty important, right?
Yeah, absolutely, Simon. I think I think a lot of people, because super's so complex and there's so many different components to it, that people sort of get a little put off by super. And typically, probably when you're younger, you'd probably rather utilise that money to do other things rather than being locked away and until, you reach retirement age. So, but for a lot of people outside of their own home, when they do reach retirement, it's probably going to be their second biggest asset. So I think it is really important that people understand super, understand the benefits of it. There's certainly a lot of taxation benefits, and it certainly can be very fruitful in terms of building up quite a nice little nest egg for your retirement and sort of utilising, the rules and the system for one's benefit. So then when you do retire, hopefully you can sort of self-fund and utilise the wealth that you've accumulated for your retirement.
Yeah, it's interesting. I mean, while the 30-year-old might not be very interested in it, by the time they get to 50 and they look at that balance, it'll be very interesting.
Yeah, and I guess a good analogy is how I always explain it to people. It's a bit like a dripping tap into a bucket. And you think, oh, well, that's not much money, and why do I have to do that? But, if that sort of tap drips into that bucket for 30, 40 years, that ends up being a lot of water or a lot of money in that bucket for one's retirement.
Yeah, that's a really good analogy. Thanks, Al. One last thing on these younger people. I understand the government's opening the door a little bit to first homeowners to access some of their super. Do you know anything about that? Or
yeah, so these are called first home super saver schemes, and there's a few little rules and regulations about people utilising some of their super to help them buy a first home. But in terms of the specific rules and how that might relate to one's individual circumstances, we probably won't go into that level of detail today, but certainly, seeking advice and see how they could be applied to, an individual situation.
Yeah, so if you're a young person and you could put money aside and get it when you want to get a house, that is an interesting story, and it's probably worth looking at. It's going to help you get that.
Absolutely, and we sort of saw in the recent federal election that Labor and the coalition sort of had two different policies on a sort of accessing super for purchasing of homes, so there are certainly ways that people can utilise some of their super to buy a property.
Oh, that's fantastic. My takeout on this, there's nothing simple. I don't know how we can call this a simple super or simply super, but it is simply super, what we talked about. The super industry is constantly moving. There's many different ways of getting money in. They're all got caps and rules. There's ways of getting money out which have got caps and rules. So it is complex. Am I fair to say that really you need to seek advice in really managing this in a good old-fashioned way?
Absolutely, Simon. I think probably the biggest takeout for people is that there are so many different superannuation strategies and rules, and they do all apply to people's individual circumstances in different ways. And so it really is best to seek advice, understand how a particular rule or piece of legislation might apply to one situation, and then working with an advisor, they will be able to sort of tailor those rules and regulations to one situation to kind of get the best outcome for them.
Yeah. No one size fits all here.
Absolutely not.
Right. Well, Al, I really appreciate you coming along to talk to us today. For anyone who wants to get a hold of you, how might they find you?
Yeah, just reach out, Alistair at navwealth.com.au, and be happy to help.
Thanks, Al. Really appreciate it.
Thanks, Simon.
Thanks for joining us today for NavTalk. You can listen to other podcasts in the NavTalk series via YouTube or where you get your favourite podcasts, or simply search NavTalk. Be sure to follow Navwealth on LinkedIn, Instagram, Facebook or Twitter. And please, if there are any particular topics you would like us to cover for a future episode, let us know via our website. I'm Simon Prowse. Until we talk again.